Good evening. It is Saturday, January 10th, 2026. This is the Global Silver Evening News. The international silver market is currently navigating what analysts are calling the most volatile and transformative period in the metal's modern history. After a historic 2025 that saw silver prices surge by more than 150%, the opening 10 days of 2026 have proven that the silver squeeze has graduated from a speculative phenomenon into a structural reality that is redefining global supply chains, central bank reserves, and industrial manufacturing. The global price action and macroeconomic catalyst. As we close out this second trading week of the new year, spot silver has reclaimed the critical $81 per ounce threshold. The metal saw a dramatic 6% surge yesterday, following a series of disappointing economic data points from the United States, including a non-farm payrolls report that showed an addition of only 50,000 jobs, well below market expectations. This economic cooling has reignited global conviction that the Federal Reserve and other major central banks will be forced to accelerate interest rate cuts throughout 2026. In the world of precious metals, lower rates translate to a lower opportunity cost for holding non-yielding assets, providing a powerful tailwind for silver. However, the price action is not merely a reaction to currency fluctuations. We are seeing a fundamental decoupling of silver from other commodities. While oil prices face a supply-driven downtrend due to weakening global demand, silver is entering a price discovery territory. Technical resistance zones that held for over a decade, specifically the $50 to $54 range, have been decisively shattered. Analysts at major financial institutions are now looking toward the next technical extensions at 88 and potentially 110 per ounce, as physical scarcity begins to dictate the floor of the market. The China export ban and the chokehold on supply. The single most significant driver of this week is market tension, is the implementation of new export restrictions from China, which officially took effect on January 1, 2026. China has long been the world's most critical hub for silver refining, processing approximately 70% of the world's refined silver. By imposing strict export quotas on refined metal, Beijing has effectively signaled that it intends to hoard its domestic supply to fuel its own massive solar and electric vehicle infrastructure. Reports from the Shanghai Gold Exchange indicate that inventories have collapsed to decade lows. In some instances, the silver premium within China has reached $8 to $10 per ounce above the international spot price, as domestic manufacturers scramble to secure metal before it is diverted for strategic state use. This China factor has severed a primary artery of the global supply chain, leaving Western industries, particularly those in the United States and Europe, facing what is being described as a vault drain. Industrial demand. The AI and green energy collision, silver AA's dual role as both a monetary asset and an essential industrial component, is reaching a breaking point. In 2026, we are witnessing the collision of two massive demand curves: the global transition to renewable energy and the relentless expansion of artificial intelligence infrastructure. In the photovoltaic sector, silver-intensive technologies have become the non-negotiable industry standard. Every attempt at silver thrifting, the process of using less silver in solar panels, has resulted in inferior performance or durability issues that the industry cannot afford as it scales to meet climate targets. Simultaneously, the AI revolution has introduced a new, price-insensitive buyer to the market. High-conductivity silver is essential for the advanced semiconductors and power electronics required by massive AI data centers. Industrial users are now facing what economists call silverflation. The rising cost of the metal is no longer a marginal concern for companies like Tesla or major solar providers. It is actively eating into profit margins and forcing price hikes on end consumer products. For the first time, silver is being classified alongside lithium and cobalt as a strategic mineral of national security importance. The institutional shift, central banks, and Basel III. The landscape of institutional silver ownership is also undergoing a radical transformation. Historically, central banks focused almost exclusively on gold. However, a historic pivot is underway. Following the lead of Russia, which allocated significant funds to silver reserves in its 2025-2027 budget, other sovereign entities are beginning to look at silver as a strategic hedge. In Europe, the implementation of new Basel III banking regulations on January 1st has forced financial institutions to reassess their paper silver holdings. These regulations require banks to hold more physical liquidity against their derivative positions. This has triggered a scramble for physical bars in the London vaults, as banks move away from unallocated paper contracts that may not be fully backed by the underlying metal. This transition is adding immense pressure to a market already suffering from a fifth consecutive year of structural supply deficits. Mining and exploration, the race for proven reserves. The mining sector is responding to these price signals with a wave of consolidation. One of the most watched developments this week is the amended arrangement agreement between Highlander Silver and Bear Creek Mining. This move is designed to streamline the merger process, reflecting a broader trend where mining companies are joining forces to secure Tier 1 assets in stable jurisdictions like Peru and Mexico. Highlander Silver's San Luis project and Bear Creek AS Karani project are among the few high-grade silver deposits globally that are poised to bring new supply to the market. However, the lead time for new production remains a major hurdle. Experts warn that most significant new mine supply is not expected to hit the market until 2027 or 2028. This means that for the remainder of 2026, the market must rely on existing above-ground stocks and recycling, both of which are currently struggling to keep pace with demand. The technical outlook and the silver squeeze reality. As we look toward the coming weeks, the technical outlook for silver remains bullish but highly volatile. While the metal hit a high near $84 per ounce in late December, it has spent much of early January consolidating in the $75 to $80 range. Analysts at firms like Citigroup and Goldman Sachs view this as a healthy pause before the next leg up. There is, however, a warning for retail investors. Silver is a high beta asset. This means it often moves more violently than gold, both on the way up and the way down. Major exchanges like the CME Group have already begun raising margin requirements for silver futures contracts to mitigate the risk of a total market collapse. These regulatory speed bumps may cause temporary price dips, which some institutional buyers are already viewing as golden opportunities to acquire physical metal at a discount. Conclusion and global summary. To summarize the state of the global silver market on this January 10, 2026, we are in the midst of a perfect storm. The combination of tightening physical supply, aggressive industrial demand from the AI and solar sectors, and a strategic pivot by central banks has created a market environment where paper, silver contracts are increasingly viewed with skepticism compared to physical metal. The implementation of China's export ban marks a definitive shift in the global balance of power for precious metals, forcing the West to confront the reality of its own depleted inventories. As the world awaits the U.S. Federal Reserve's next move later this month, the floor for silver appears to be rising, driven by a fundamental scarcity that no amount of financial engineering can easily resolve. Stay tuned for our next update as we track the daily developments in this historic market transformation.